Senior here, welcome to another YouTube video. Today I'll be talking about basic market structure. The reason why you can't analyze the market properly, the reason why you keep hitting stop loss and all that. So let's get into the video. So let's say we have two types of market structure. We have the trending market and we have the ranging market. So this is the trending. Under the trending market, we have the uptrend, which is a series of higher highs and higher lows, right? We have the uptrend and we have the downtrend. And we say the uptrend consists of higher highs and higher lows, right? So we say the uptrend consists of higher highs and higher lows. I think this is the fundamental of technical analysis, but the thing is that majority of us still do the mistake of not marking the structure properly. So when you are marking an uptrend, it simply means that the higher high, your current high must not be higher than the previous high. You understand? So when you are marking an uptrend, your current high must not be higher than the previous high. What do we mean by that? This current high must not be at the same level with this previous high. It must be higher than it. So a situation whereby you have an equal high, you can't call this a uptrend anymore. Why? Because the market can decide to give you something like this, a double top, then reverse all the way down, something like this. So you can't call this a uptrend. This is what we call a uptrend: a higher high, a higher low, a high higher than the previous high. You understand? A high higher than the previous high, that's our higher high. Then we have another higher low. Then this our low must be lower than this previous, must not be lower than this previous low. So this is what I mean by that. Higher high, right? Higher low, higher high, higher low, higher high, higher low, higher low. But a situation whereby this low is lower than this previous low, that's no longer an uptrend. It simply means that the market has changed bias. But that's not what we are talking about today. We are talking about the trending market and the ranging market. So that's for uptrend. Why for downtrend? We have a series of lower highs and lower low in uptrend. In downtrend, I mean. So we have a lower high, lower low, a lower high, and a lower low. A lower high. Our lower high must not be higher than the previous high. This simply means this new high must not be higher than this previous high. You understand? So that's how to mark the trending market, which is our uptrend and our downtrend. I think we understand that. And if you don't understand, you can just comment below under this video, then I can enlighten you on that. So this is like the basic of technical analysis. Why our ranging market, we have a series of high, then the markets come down. So the market is reacting from a support. This is our support level. This is our support level for the fact that the market is bouncing off from this area. So this is our support level. We call this support. Why we call this resistance. So we call this resistance and we call this support resistance. Why is this called resistance? This is called resistance because it's resisting this market from breaking out. Do you understand? So we can have a ranging market like this. We can have a ranging market like this. So this is a ranging market, a market that doesn't have a defined area. You know, we say for the uptrend, giving us a series of higher highs and higher lows. Why for the downtrend, giving us a series of lower highs and lower lows. But for the ranging market, gives us support and resistance, resistance to support, support and resistance, resistance to support. Now let's go to a live chart to mark all these things out. So if we check gold on 4-hour time frame, we see that gold is giving us a trending market right here. So who can tell us the type of trending market that this market is giving us? You can comment below. So you are right, this market is giving us the uptrend pattern, right? So And as you can see, from here, from this particular point to this particular point, we can call this a range market. Why? Because gold is not giving us a divine area right here. So you can see that the market is reacting from support to resistance, from resistance to support, from support to resistance, from resistance to support. So this till this level, then we have a breakout out of this level, right? So that's for range market. Let's look for one more example for range market. Coming to this area on gold, that's 4 hours time frame. Then I have this level. You can see that this market is not trending. You have a series of support to resistance, resistance to support, support, support to resistance, resistance to support, support to resistance before the market breakout. So this is an example of a range market. Now the next market we'll be looking out for is the trending market, which is the uptrend, right? So for the uptrend market, we have series of higher highs. Mark with me: higher highs, higher low, higher high, higher low. As you can see that this high is higher than this previous high. So we have a higher high, higher low, right? Then we have a higher low, higher low, higher high, higher low, higher high. Can you see that this high, this low is not lower than this previous low? So it simply means that this market is still in a functional uptrend. So you have a higher low, higher high, then the same point is not lower than this previous low. So you can still call this a uptrend. Then higher high, then higher low, higher high. So this is the way you can mark out your structure without giving you headache. Because some people will just say, oh, this is higher high. Some people will be like, oh, this is higher high, higher high, higher low. No, it doesn't work that way. You have to mark. There is something we call internal structure and external structure. I'm going to do another video about that, but let's focus on this particular topic we are talking about, which is market structure. So you have a series of higher highs and higher lows in the uptrend. Just have this at the back of your mind that you have a series of higher highs and higher lows on the uptrend. Then you have a series of lower highs and lower lows on the downtrend. So guys, that will be all for today. So before I cut this video, let me give us let's do an example on the downtrend market. So for a downtrend market, as you can see here, we have a series of lower high, right? Lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. Can you see? It's as simple as that. It's as simple as that. So this for a downtrend market. If we check here also, we have a series of lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower low. It's as simple as that. So that's just the basic market structure that you need to know. No matter the type of strategy you are trading on the forex market, you have to know the basic market structure, because that's what tells you the direction of the market. You can't just enter a trade without know where the market is coming from or what the market is going through. You have to know the current market structure you are in. And for this good on a 2-hour time frame now, you can't say you want to sell on this particular trend, because you can see that the market keeps trending, higher highs and higher low, series of higher highs and higher low. So a situation whereby this market break this last higher low, then we can see that we can look for some other confluence to sell the market. But for now, we can't sell the market because we are still bullish on gold. So that's just all we'll be talking about today. And don't forget to like, subscribe, and drop your suggestion in the comment section. And you can also join my Telegram channel where I send all my free trades. My signal is absolutely free. You can join. I'll see you in the next video. Bye.